I just want to start on how much you think these price increases will last.
Well, just as Julian said, it's going to depend on two things. A further escalation in hostilities, which seems there's a distinct possibility that occurs, and how long these hostilities remain. So at this point, we're looking at a situation of, wait and see. The market now is certainly pricing in greater volatility. What we saw leading up to this, i.e. before last Thursday, was a market that was switching into contango. Both the Brent market and the WTI market, beginning in 2026, had switched to a contango market where prices for January are cheaper for prices than February and so forth. This is a classic fundamental telltale that the market was pricing in that supply was going to outpace demand. Now, of course, with what we've seen over the past week, that situation has now moved into, well, we're back to backwardation. So now January is trading at a premium and so forth. So the market is pricing in potentially higher prices through the end of this year and into the start of 26. And that has been the real sea change in the oil market over the past week or so.
Stephen, does the world have options with regards to supply if the hostilities were to persist or if the hostilities were to get worse than where we currently are?
We're kind of limited, Brian, at that point. Iran is still a significant player in the market. This all depends on whether we're going to see a disruption to crude oil coming out of the Persian Gulf. That seems highly unlikely. The Iranians are not going to cut back their production. They actually need that production. They need that export income. Second, they're not going to close the strait, I believe, because it would alienate their two major clients, India and most importantly, China. So if you did see a disruption to this oil, then that puts China and India onto the world market, especially with China, because 90% of Iran's exports go to China. And then you have the third factor is if you do see a disruption, i.e. a cutoff of the Strait of Hormuz, you're going to alienate your OPEC brethren. So that is to say that, look, if you know your history, you know there's not a lot of love lost between the Sunni Arabs and the Shia Persians. So at this point, you're probably getting some glee coming out of the Arab world of what the Israelis are doing. Now, if you cut off the Strait of Hormuz, then you're likely to see the Arab nations kind of come from their undergrowth of pushing, or I should say their glee with what's going on, and could actually push them into hostilities. From an Israeli standpoint, they're not going to take out Iran's production because best case scenario is you do see a regime change. And the last thing the Israelis want to do is to take the ability to make money out of that new regime's hands.
Do we have a sense of what the Chinese may be messaging to the Iranians right now?
Certainly, I think that there is some reports, and I'm certainly not a military strategist, that you are seeing some planes fly into Iran. Question is there military hardware on that? But certainly, I think more obviously is they are getting pressure from China that they do want a resolution to this. They do want a free flow of oil. We've already seen oil prices jump $10 a barrel over the past, 5-6 days. So clearly this is going to be when 90% of your oil is coming from a nation that is causing really this spike in price. There is going to be pressure coming out of Beijing to ease the situation, i.e. ease prices lower.
I wonder what the production response is going to be. I saw that in the United States, a number of oil companies had taken their rigs out of production. I'm wondering how many of those come back online in response to the increase that we've seen in oil prices rising. How much this gives a boost to some of those companies that have really lamented how low prices on oil had gotten.
Yes, exactly, Lisa. So what we saw coming into this year was a survey by the Dallas Fed of the 11th District, which is the oil price. And slightly more than half the respondents, the survey went out to oil executives as what price do you need to see for to increase CapEx? And slightly more than half of that price came in that $71 to $75 range. Now, WTI it took this process, this war, or I should say the expansion of this war, because this war began on October 7th, 2023. So you would need to see oil sustained over $75 a barrel until the industry is confident that this price rise has staying power. So at this price, at this level, there's still a lot of confusion of whether or not of how far this escalates, if it even escalates even further. So you will need to see sustained prices for, I think, at least a quarter for the market to actually, or for U.S. producers, companies to actually respond to this price level.